Listen very carefully, because what I'm about to tell you may completely change how you think about investing over the next decade. The difference between people who build real wealth and people who stay stuck financially is not intelligence, luck, or timing. It is positioning. And 2026 is going to be a year that brutally exposes who is positioned correctly and who is not. Most investors are looking in the wrong direction. They are chasing hype, headlines, and short-term excitement, while the smart money is quietly accumulating assets that will dominate cash flow and value for years to come. The global economy is not going back to what it was. Cheap money is gone. Easy growth is gone. Central banks have made it clear that volatility, higher interest rates, and tighter liquidity are the new normal. This environment punishes speculation and rewards ownership of real, cash-producing businesses. If your strategy is still based on hoping stocks go up, you are already behind. In 2026, the winning strategy is owning companies that generate predictable income, have pricing power, strong balance sheets, and are positioned in unavoidable long-term trends. This video is not about gambling on the next hot stock. It's not about day trading or getting rich overnight. This is about identifying the types of businesses that thrive regardless of political cycles, recessions, or market fear. These are companies that sell products and services people cannot live without. They generate cash in good times and bad times. They pay shareholders while they wait. And most importantly, they compound value over time. Here's the uncomfortable truth. Most investors lose money not because they pick the wrong stocks, but because they don't understand what kind of market they're in. 2026 will not reward impatience. It will not reward hype. It will reward discipline, income, and fundamentals. If you understand that now, you are already ahead of 90% of the market. Video, I'm going to walk you through the best categories of stocks to invest in for 2026, explain why these sectors matter, and show you what characteristics to look for, so you can make intelligent decisions instead of emotional ones. These are the types of stocks institutional investors, pension funds, and high-net-worth individuals quietly accumulate while retail investors are distracted. If you want to build long-term wealth instead of chasing short-term noise, stay with me, because what comes next is not opinion, it's math, history, and strategy. The first category of stocks that will dominate portfolios in 2026 is dividend-paying companies with long track records of consistency. In an environment where inflation erodes cash and volatility shakes markets, dividends act as a stabilizing force. They are real money, paid in real time, directly into your account. A company cannot fake a dividend. To pay one, it must generate cash, manage debt responsibly, and run a sustainable business model. The smartest investors understand this simple truth. Price goes up and down, but cash flow is reality. Dividend stocks shift your mindset from speculation to ownership. Instead of hoping the market rewards you, you demand the business pay you for your capital. This is how wealth becomes predictable. In 2026, the strongest dividend stocks will come from sectors like utilities, consumer staples, energy infrastructure, financial services, and healthcare. These businesses sell essentials, electricity, food, fuel, banking services, and medical products are not optional. Even during recessions, people keep paying for them. That demand stability allows these companies to maintain profits and continue paying shareholders. What separates great dividend stocks from bad ones is not yield alone. Chasing high yield without fundamentals is a mistake. The key is dividend sustainability, free cash flow, reasonable payout ratios, manageable debt, and a history of increasing dividends year after year. These are signals of disciplined management and durable business models. Dividend growth matters just as much as dividend yield. A company that increases its dividend annually compounds your income over time. That growing income can be reinvested to buy more shares, accelerating long-term wealth through compounding. This is slow, boring, and incredibly powerful. In 2026, dividend stocks also provide psychological stability. When markets pull back, dividend income keeps arriving. That income reduces panic selling and allows investors to stay invested during volatility. The market transfers wealth from the impatient to the patient, and dividends reward patience. For investors who want predictable returns, inflation resistance, and long-term compounding, dividend stocks should form the backbone of a 2026 portfolio. This is not exciting. It is effective, and effectiveness is what builds wealth. One of the most powerful forces shaping investment returns in 2026 and beyond is demographics. You can ignore headlines, politics, and market noise, but you cannot ignore aging populations. Every single day, thousands of people are turning 65. This is not speculation. This is mathematics. An aging population consumes more healthcare services, more prescription drugs, more medical devices, and more long-term care. This creates a massive, unavoidable demand pipeline for healthcare companies. And unlike many industries, healthcare demand does not disappear during economic downturns. People may delay buying cars or houses, but they do not delay medical treatment when it is necessary. The strongest healthcare stocks in 2026 will not be speculative biotech companies chasing one miracle drug. They will be established firms with diversified revenue streams, global distribution, strong regulatory positioning, and consistent cash flow. Companies often operate behind the scenes, supplying essential products used in hospitals, clinics, and laboratories worldwide. Healthcare companies also benefit from pricing power. When a product is essential to patient outcomes, price sensitivity decreases. This allows healthcare firms to maintain margins even when costs rise. That pricing power makes them resilient during inflationary periods. Another advantage of healthcare stocks is balance sheet strength. Many leading healthcare companies carry manageable debt and generate enormous free cash flow. This allows them to invest in research, acquire competitors, return capital to shareholders, and adapt to changing regulations without jeopardizing financial stability. In 2026, healthcare stocks also serve as defensive growth assets. They offer steady earnings with long-term expansion driven by demographics, innovation, and global healthcare access. This combination of stability and growth is rare and extremely valuable. For investors thinking long-term, healthcare is not a trade, it is a structural allocation. It belongs in portfolios designed to survive decades, not months. If you want exposure to one of the most predictable demand trends in the world, healthcare stocks are essential. Energy infrastructure stocks will be some of the most misunderstood, yet profitable investments. In 2026, while media narratives focus on energy transitions and political debates, the reality is far simpler. Energy demand is growing, not shrinking, and energy must be transported, stored, and distributed regardless of price. Pipeline operators, storage facilities, and energy infrastructure companies function like toll roads. They do not care if prices go up or down. They get paid based on volume and long-term contracts. This creates predictable cash flow and allows for generous, reliable dividends. Companies possess enormous competitive moats. Building new pipelines or infrastructure is extremely difficult due to regulation, capital requirements, and environmental approvals. That scarcity protects existing operators and strengthens pricing power. In 2026, energy infrastructure companies will benefit from natural gas demand, export growth, power generation needs, and energy security concerns. Even as renewable energy expands, traditional infrastructure remains essential for backup power and grid stability. From an investment perspective, energy infrastructure stocks offer income, inflation protection, and lower volatility than commodity producers. Their revenues are often contractually locked in for decades, providing visibility few industries can match. for investors seeking yield and resilience. These stocks provide a rare combination of predictability and long-term relevance. They may not be glamorous, but they are foundational to the global economy. The investors who succeed in 2026 will not be the ones chasing excitement. They will be the ones building portfolios designed for reality. That means owning dividend payers, healthcare leaders, infrastructure assets, and businesses with pricing power. Diversification across these sectors reduces risk while maintaining income and growth. It allows investors to stay invested through volatility and benefit from compounding over time. This approach is not flashy, but it is repeatable, scalable, and proven. Cash should be treated as a tool, not a strategy. Excess cash loses value. Productive assets create value. The transition from saver to investor is the most important financial decision most people ever make. If you focus on cash flow, balance sheets, and long-term demand trends, 2026 becomes an opportunity instead of a threat. Markets will fluctuate, headlines will change, but ownership of strong businesses endures.